The standard deviation of risk, again, though, is different too, 22.68 versus 34.12. The key point to this page is that we take risk where risk is rewarded. On the way home tonight, you could drive down the highway, set the cruise at 90 and close your eyes, and you're taking a risk, right? There's no positive reward that could possibly come from that, but you're taking a risk. And you could also market time, and you could stock pick, and you could track record invest. Also 3 risks that have no academic research or proof that it creates return for you. There is documented historical return for 70 years in each one of these categories that goes on and on and on, that says you're rewarded for taking these kinds of risks. And we are not going to take risks where it's not rewarded. Does that make sense? So that's the 3-factor model. So the truth is the components put together. Free markets work, plus the theory, plus the model equals free market portfolio theory. And I'll just give you an example of it, and we'll wrap up. Everyone doing okay? So there's an answer to this depressing reality. If you want to write the snapshot in here, we'll give you a chance to do that in the green arrows here in a minute. Free markets work is the philosophy. Prices reflect values. You just write free markets there. And then modern portfolio theory, you can write MPT. If you Google MPT, that's probably what's going to show up. So you can figure out modern portfolio theory pretty easy. The 3-factor model, if you Googled that, you're just going to get Eugene Fama's name, because he came up with it. Ken French, maybe. Equals free market portfolio theory. All right, so building a better portfolio. We are going to go to that green page where there are 6 circles, and the 6 circles is an evolution of the building of a fund. It's not 6 separate portfolios. It's building a portfolio by adding things to it slowly. Okay. So again, like the others, we're just going to write in the numbers. When I meet investors, I'm generally meeting them relatively frustrated. They generally have 100% of their money in equity mutual funds. It's generally large U.S. companies or large international companies that generally don't own any value, or small companies. And their returns have been frustrating. Maybe they know what their return is. I actually had an engineer once, he came in and he'd been to my presentation and he was going to come in for the follow-up meeting, and he said, "Evan, I did the research." I said, "What do you mean?" He said, "I got my pay stubs out for the last 11 years, and he determined exactly how much he put in and when, and he hadn't changed his fund structure at all, so he hadn't been chasing after returns." And he said, "I estimated I got about a 4.9% rate of return over time, during a period when the market had done 3 or 4% better than that." And so we determined he had behaved, he hadn't bought and sold, but inside those mutual funds there had been some trouble. So he had done it. It's very difficult to do, but an engineer with a good Excel spreadsheet, I guess you can make it work. But this is where folks are, and the reason that the returns are in the sub 4% range and the standard deviation of risk is near 20 is because the average holding period for a mutual fund is less than 4 years. Track record investing by the investor and sometimes by the mutual fund manager exists. Hyperactive stock picking and market timing also exist. So these are the reasons why most investors are frustrated where they're at, or not getting the returns that they could be getting. And so the first decision is to move to an indexing platform, to move away from active trading. And if you move away from active trading, you can get the market return. And for this portfolio anyway, it's just the S&P 500. Okay? And what you see is, you see the standard deviation of risk actually come down, but you see some return being added. All right? Last time I did this, it was my cell phone that went off 3 times. All right? Now, we also want to ask that first question. This is the market question, right? How much of the market should I be in? And for this purpose, we have portfolios all along the spectrum. But for this purpose, I'll just say that we're going to be in 40% bonds or fixed income. We're going to be in 60% stocks. And this lends to your question. How much do you lose in the return for picking up 40% bonds? Well, you lose about 0.5% for picking up bonds. Right? Not a lot, but look at the standard deviation of risk. This is the difference between a fund that could go down 50% in a given year and a fund that could go down 22 or 23% in a given year, given a historical evidence of 80 years. Would you rather get 9.26 and have to look at volatility like this, or 9.81 and have to look at volatility like this all the time? Well, you're going to make better decisions in a less volatile fund. But we haven't even added the 3-factor model yet. We'll get into that. The next split is to add international. So we get international by splitting the US large companies up 30% each. And you bring a little return in. International large versus international US, let me say this right, large international funds and US large funds essentially act the same. There's a little bit of correlating benefit there. You don't see the standard deviation of risk go up. You do get a little bit of benefit in the return. And now we're going to look at the size. So we add small US companies, the very smallest, the 9s and 10s, and we add international small, and we split the 30% up 15-15 each. And here's where we start to beat the market, if you will. You can beat the S&P 500 return, and you can do it with a third of a reduction of risk, 2/3 of the total risk. And then we add the value companies, and we actually have value international, but for purposes of a screen size and for making the point, you can add a little bit more return. Now you can be at 11% return in your fund and a 12% standard deviation of risk. That value factor actually adds a pretty volatile component. That 34% standard deviation of risk, if you remember from the previous page, actually brought your total risk down because of how it correlates with the other components of the engine refund. That makes sense? Now, the manager in this scenario, the investment manager, has a set fee every year regardless of performance. And generally, and it's been true of us, as our money management grows, as we reach 20 million and then 40 million and then 50 million under management, our fee structure to every client gets better. Our economies of scale come into place. We're actually reducing our fees to you the more we take in. It's the exact opposite with the active money managers. The fees with active money management is the more that they take in is generally because of the higher returns that they got over a short period, and their fees generally rise. So the better your portfolio is doing, the more money you're putting in it, the less it costs you, and the more of that you get to keep. And our net return to our clients over a 19-year period has been within 1% of the proxy, if you will, or of the index. So if we say you should be getting 10.99%, that's what the market's getting, that after the costs that you're paying, you're getting about 10. And we can show you the actual investor performance over a 19-year period, that when the market averaged 11, our clients averaged 10 point something. Because it's the market that creates return. It's not the manager. It's not your ability to decide I should be out of the market, I should be in the market. It's not me creating return for you. The market's creating return. What we're doing is engineering the fund, rebalancing it, keeping you disciplined, even when your emotions are getting the best of you in the middle of 2008. When you get that statement in March of 2009, I had a lot of meetings in March of 2009. I could tell exactly who had signed up for online statements and who could see their balance every day, and I could tell exactly who had to wait till March or April 1 to get their information in the mail, or April 7, because I got a lot of calls on April 8 when they got there, when they opened their letter. And I was able to tell when we saw, and I'll just show you this, and then we'll have some questions. The right activity for a portfolio, let's say my average client's in about a 60-40, so I've got some retired folks who are in a 50-50, and I've got some aggressive young people who are in 95% stock allocation. But if you look at a 75% allocation to equities and 25% allocation to fixed income, okay? And if this was $100,000 in 07, all right, it was not $100,000 in 3 of 09, right? This fund was actually at about